Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hansen and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth's Money Matters. Scott Hansen here.
Pat McClain.
Thanks for being part of our program. Both myself and my co-host, we are both financial advisors, certified financial planner, chartered financial consultant. We spend our weekdays helping people like yourself plan their financial futures, and we air this program on the weekends to be your financial advisors on the air. And I think we have more podcast listeners today than we have terrestrial radio.
So thank you for listening.
But then again, we used to broadcast live in the Bay Area that we don't any longer. The station changed so dramatically that it, whatever.
I don't know.
But then again,
it's podcast. It's podcast.
One of how many hundreds of financial podcasts there must be now?
Oh, maybe thousands.
Maybe thousands.
Maybe
we
thousands.
think ours is the best.
Okay.
So I hope you do as well.
So let's talk a little bit about debt. Right? Because
that's always the most fun to start with.
That is, but it's real.
And we'll take calls during the program.
It's real. The nation's debt burden will surpass its historic high point in decades. And when you talk about debt, it's just not the dollar amount. It's relative to something.
Right.
Because
if my 23-year-old son had 30 grand in debt, unsecured debt, that's a huge number to him. If Bill Gates has 30,000 in debt, it's nothing.
That's right. So it's relative to something. So right now, we're reaching 107% of gross domestic product. It's projected to reach 107% of gross domestic product.
That means
by the year 2031.
More than our annual output in.
And this is the highest level as a percentage of GDP since World War II. And this is scary. We should all be concerned about this. All of us. Because this debt will have to be repaid.
But there's a whole kind of this modern monetary theory. I mean, there's a school of thought out there that debt no longer matters.
My son is graduating the economics degree from UCLA.
And that's one of the things they study?
And that's one of the things.
And what's he think of it?
He thinks it's not a big deal.
What's not a big deal?
The amount of debt.
Can it go on for eternity like this?
He doesn't.
Or just one generation?
I have these conversations and he keeps telling me I don't understand because it's not a big deal. The interest rates are low. It makes sense to reinvest back in the economy because the return's going to be higher over the long term, so we shouldn't worry about debt.
What if rates go up?
He said that is a...
what is the statistical probability of interest rates being higher in the next 20 years?
At the same time, he says that because the Fed actually has so many levers to pull and they've gotten so good at it, that the chances of debt going up, interest rates going up significantly is
well, there we go.
Not there.
We heard it right there from my almost graduate from UCLA economics.
He gone.
Don't need to read this.
Right. It's what if, though. What if?
It is...
I think we should all be concerned.
I tell you what, the biggest risk for retirees is inflation.
Inflation.
Always has been, always. That is the biggest risk for retirees. And you look at countries that have gone through some upheaval. When the Soviet Union fell, the pensions suddenly became worthless because the ruble was, hyperinflation is disastrous for retirees, pensions, fixed income. So we have no inflation, relatively low inflation now. But look, if I was retiring today, I'd want to make sure I've got everything planned such that if we have a period of high inflation, I've got some assets in there that are going to keep pace with the rate of inflation. So
which is equities, stocks.
Yes, you need to have some things in there. So anyway, that's let's take some calls because the calls are more interesting. 833-99-WORTH is the number to be part of the program here. 833-99-WORTH. That's 833-999-WORTH. 6784. That'll get you on the program. And let's start off here. We're going to talk with Robin. Robin, you're with Allworth's Money Matters.
Hi there. How are
Robin.
you?
We're wonderful.
Good. So, question about long-term care policies.
All righty.
Yep.
And my question is, I've had it since 2004, and I was 50 years old, and so now I'm a little older. I guess I'll be 67 next month. And the premiums have gone up 40% at this point, and so I always get mad and want to quit it when it's going up, and I don't know when it's going to stop. But I wanted to hear you guys' opinion on it.
You've probably read enough to kind of understand what happened in the insurance world and why that is, right?
Yes.
It's not that they're out trying to really take advantage of people. It's just that they mispriced it, frankly.
And they never expected interest rates so low, which is, what an insurance company takes those monies and they invest them in a reserve fund. And part of that is, a large portion of it is bond. And with interest rates dropping, their returns have subsequently fallen as well, which means there's two things. One, they mispriced these morbidity tables, and then they mispriced where the bonds were going to, the yields. But the big question is, do you need it? Because if you have lots and lots of money,
Bill Gates,
then you can actually...
I don't think he has long-term care insurance.
We're safe. We're safe. No, I'm not a Bill Gates.
And if you're broke, you don't need it. Well, you can't buy it anyway. If you're broke, the state will take care of you. It's kind of in the middle. It's where people get squeezed. And those are two great examples. But
so give us a little rundown on your financial situation. How much income is coming in? I assume you are, do you have a spouse?
I do.
And you're both retired?
Yes. And he's 60 and I'm 67. So
and how much
we live a pretty simple life. And
how much income comes into the household on an annual basis?
About $45,000.
And how much money do you have in savings?
The portfolio at this time is sitting at $3 million.
Okay, and this $45,000 a year, your husband is not on Social Security, but you are?
Yes, I just went on it. Yeah.
Okay.
Yeah. So the money's coming from basically dividends from our investments and from my Social Security. And what else? Let's see. What else is it coming from?
And how's the long-term care insurance policy structured? You're paying X dollars per year in exchange for what? Yeah.
Well, looking at it, I think I may have a gold account. Basically, it's got maximum lifetime. It's unlimited.
Oh.
Originally, I had a maximum day rate of 180 back in 2004, and I bought a high nursing home price rider on it. So now, currently, it covers up to $392 a day. So,
and how much are your premiums?
Covers. Let's see. They will be in 2023 when they're finished with this 3 years of increasing. It'll be $7,000 a year for the two of us.
And your home, I assume, is paid for?
Yes.
And how long is the waiting period, the elimination period on this?
We went for 30 days.
So at a minimum, I would try to extend that out as long as possible.
I doubt it saves much on this policy, though, Scott, because of how it was underwritten all those years ago.
I mean, it is a phenomenal policy.
It is an unbelievable policy.
That's what I'm thinking. When I called a friend and asked them, I was like, oh, my gosh.
It's an unbelievable policy. You should keep this. You should keep it.
Okay.
Let's look at this. $7,000 a year.
Just take it right out of your portfolio. Do not take it out of your cash flow.
That's right. Just take it right out of the portfolio.
Take
it's
it right from the portfolio.
Protection. That's what you're buying.
Okay.
That is what they're buying. It's a good way to look at it.
Right, because you could afford to insure yourself, right? Which you've got $3 million. If both you and your husband, by some weird circumstances, went into a long-term care facility together.
You can last a long time for $3 million.
Yes, you could last indefinitely.
Right.
But in fact, who's the beneficiaries of your estate?
Our daughter.
Okay, just send the bill to her and ask her if she wants to pay it, because that's who it's for.
I know what she'll say.
But that's who it's for. That's
keep it.
That's truly, if you think about it, because you can afford to self-insure. You decided it years ago, quite some years ago, when you were in your 50s, that you were going to pay a premium for someone else to take this risk. And even though it's gone up by 40%, by the way, which is not a large increase on a long-term care policy in the last 16 years, it's not that large at all relative to what we have seen others. Pay the 7. If it goes up to 12, pay the 12. If it goes up to 15, pay the 15. Take it right out of the portfolio. This is money well spent. Now, the rest of the listeners, this is... Robin has gotten a really good deal on this policy.
If for $3,500 each, somebody can go out and buy this policy, I would have this policy.
Yes.
You can't buy that today.
You can't buy it today. So
this is no longer available.
No,
definitely
not even close. Not even close. And as long as the company's financially secure, you're fine.
Yeah,
So-
and they are. It's huge.
Oh, perfect.
Just take the money right out of your portfolio. Do not have it come from your cash flow.
Yeah, do not do
Don't
that.
skip a weekend trip because you don't have the cash because you paid your long-term care insurance.
Yeah, in fact, you should start spending a little bit more of that $3 million if you're living on just $45K a year.
That's what I was thinking. And that is so hard to change.
I know. That's why you have
a lifetime of saving.
I know.
That's why you have it. You show me someone that doesn't care about money, I'll show you someone that doesn't have any. No, truly, it's
all right.
It's
all
difficult.
right. That's a good challenge for the year.
No, but here's how to do it. Just you don't have to start large. And remember, your husband's going to start Social Security in a couple years.
Yes.
In this situation, I would start sending myself an extra $1,500 to $2,000 a month. Just send it. And your advisor, if you want to know where it comes from, so it's in your checking account. You're going to withhold taxes on it. Start somewhere. A good advisor will actually.
How much is this in IRAs and 401ks and?
Let's see. 1.5 is in equities.
No, yeah, but in
$1 million is in IRAs, traditional IRAs.
How about 401k?
And then 500 in Roths.
And did you inherit any of this money?
So you,
No.
and you've been converting some to Roth over the years.
That's what we're in the middle of
Beautiful.
doing now.
Yeah,
so
good.
I actually have another question on that one if we
fire
have
away.
time.
Go ahead, fire away, because this is interesting.
Oh, yeah, I'll spend all day talking with you. Seriously.
There are some calls you're like, oh my.
You're like, do this call ever end? You're like, Robin, she kind of got it together.
All right. So I listen to you guys a lot, and so I hear you say regarding Social Security, if you don't need it, then take it. And so, I was questioning that logic. And so then we ran it through our little program that my husband's created. And so I'm looking at doing Roths, and what happens if we take a Social Security early, then that reduces the amount of Roth that we can convert,
That's
correct?
Right. That is correct.
Otherwise it puts us into a bigger tax bracket.
That is 100% correct.
You got to run the numbers multiple ways.
Yeah.
And then you make a bet, you make a guess.
And the reason we say that, Robin, is it's because we worry about more legislative risk than financial risk to Social Security. And so you're right now at $45,000. I like the strategy you're using. You might put off his Social Security until age 65 or 67. That's with the assumption. That's with the assumption that there is no legislative change. And what are legislative changes? Who knows? Right?
That was my question. Is it better? Were you guys also suggesting basically it's better to get your foot in the door in Social Security so that you would be grandfathered and not impacted so much if we
think
wait
about this.
And then something's happened?
Let's go out 10 years from now when Social Security Trust Fund is bankrupt.
And when you have to take required minimum distributions.
Yes.
Right?
Yes.
So you've got to.
That's the
Okay, so right now we got
storm.
Okay, well, that's what's in front of us. And it's not 30 years out. That's 10 years from now, 9 years from now.
And you're doing the Roth conversions, right? So you want to do as much of the Roth conversion, obviously, before his age 62.
Yeah.
Right, which would be the earliest he could start.
And then it just
Social
means you
Security.
can't convert. I'd probably still take it.
Yeah, I'd probably take it. And what we worry about, we don't even talk about it on the show, is what state of California has recently done this, started talking about a wealth tax. What's wrong with the federal government saying at some point in time, okay, for you people that have net worth higher than X, this is how your Social Security is going to be.
Well, of course, I could see that happening.
Well, not net worth, income.
Whatever.
The only net worth tax we have right now is an estate tax. That's the only net worth tax that exists today.
Because dead people have a hard time defending themselves.
Yes.
Yeah.
All right.
So now you're saying that
Worry about
you're
that in 2
recommending
years.
that we still do 62 for
No, I
his-
don't know.
I'd answer that question
When he
a
was
month or
62.
so before that. Yeah.
Yeah, but I would do the Roth
Okay.
conversions today, but I wouldn't, you could spend time worrying about it, but you're going to get...
And that long-term care, seriously, just make sure the money comes from the portfolio and not out of your living expenses.
And if you were sitting in our office today, we'd say, once a year, here's the money for the long-term care.
Yep.
And then, oh, by the way, we're going to, if the Roth conversions may make sense, but you really need to spend a little bit more money on yourself. No, truly.
You can't take it with you.
Yeah, I know.
Listen,
Yeah.
You're going to give
I
it to, you're either going to consume it yourself or you're going to give it away either while you're living or when you die. That's your only option.
Robin, I didn't grow up with any money, but I tell you what, I fly first class today. You know why I fly first class? Because I know when my kids get it, they will. I'm trying to beat them to it.
Yeah.
But you didn't
All
fly.
right, all right,
You didn't
I
pay
got
for it
it.
for 50 years.
I
I
can
can
do it
manage.
for look, spend it.
I can rally.
Oh, good deal. Appreciate it.
Wish you well, Robin.
All right. Thank
Thanks.
you.
All right. And by the way, I should point out, I don't always fly first class. Normally when I'm going on business and I'm by myself. With my whole family, the six of them.
I flew with my wife a couple weekends ago, and I get upgraded sometimes because I fly enough, but I didn't pay for it, and there's 2 legs, and the first leg we're sitting together, and I did explain to her, I said, when I'm with you, when there's 2 of us, we can kind of lean into each other. I don't have to worry about being stuck in some middle seat behind 2 strangers. But when I'm by myself,
You have to sit there?
no, I have to sit in first class seat, of course.
It's not like you need leg room.
Every seat's a first class seat to me. I'm a little guy. It's one of the benefits about being small.
So I joke, but I do fly first class sometimes. But with my family, we're normally
Or whatever.
all right. Do you-
Continuing on with calls, we're talking with Joe. Joe, you're with Allworth's Money Matters.
Hey guys, thanks for having me on.
Yeah.
I have a Social Security question. I'm from Northern California. I've been here all my life, and I'm 52. And I retired when I was 50 from a city government job, and so I have a pension. But while I was in college, and now that I'm retired, I'm working part time, and I'm putting money into Social Security. So when I did my own research about what I'm going to get, I can't get a straight answer whether or not I'm going to get some Social Security, whether I'm going to get zero,
Yep.
will it be reduced to zero?
So you,
That's my concern.
so you're receiving a government pension now? Is that correct?
Yes,
Okay.
it's from a city. It's from a city government.
Got
So
it.
it's not federal.
Yeah, but
So
it's from
city government.
it's
And
from
you did not contribute to Social Security throughout your other working years, correct?
I did because what I did was I subcontracted like a side job, and so I paid into Social Security part time while I was working full time.
Got it.
So,
how much?
Well, I looked at my Social Security. I went online, and it says that I have the necessary 40 work credits to receive benefits. But then I also heard that you have to work at least or put in at least 30 years into the Social Security system
No.
Well, that's not true.
to get some money back.
No, 40 quarters.
Yeah, that 30 years. I don't know where you're getting that from.
I got this from the internet.
Okay. Well, I've read the internet. I'm almost done with it.
Here's what if I were, so you will have there will be an offset.
But
windfall elimination.
But for him, it's almost nothing.
It's not going to be, and I was just going to say I would count on nothing.
No,
That's what I'm saying, because my pension.
He's working now.
Because my wife's
he's working now. So
I know.
he's not going to see a huge reduction in his Social Security when he goes to get it in 10 years because of his county Social Security, because the stuff that you were putting in while you were working most certainly had an effect.
Yes. So are they going to look at my income? And if I'm married and my wife's a teacher, so she's going to get a pension also, and then she worked part-time also. So we're both married.
So how much will your pensions be in retirement?
Combined, it'll be about $170,000.
And you're worried? Why?
Well, I'm not worried. I'm concerned that I'm putting money into Social Security.
You have no choice.
But you have no choice.
If you want to work.
I know, that's the thing.
But you have no choice.
Like I said, I've seen where they said I'll get something.
Yeah, so windfall elimination provision. But there's a second issue that I'd be concerned about too. You're 52, right? So 10 years from now, first of all, there's a good chance that in 10 years from now you can't collect it early. So now we're really talking about it's 15 years before you're eligible. In 9 years from now, the Social Security Trust Fund is bankrupt. Shouldn't say bankrupt.
Okay.
Well, yeah, because they'll be done with the reserves. They're not going to be collecting enough money to pay out all their beneficiaries. They're going to have to figure out some way to do it, to cut somebody, because if they don't, everyone gets an automatic across the board reduction of 20 some odd percent. That's not going to fly to the widow who's living on $622 a month in the middle of nowhere, right? So
Joe shows up with his income of $170,000 a year with his wife
of
and
pensions,
with pensions, guaranteed pensions, and says, "Hey, my turn at the window. I need this money to live." And the Social Security goes, "All right, we can give Joe this money because he's got $170,000 a year income, or we could cut this lady off in Topeka, Kansas, who's 78 years of age."
I would bank on getting not one dime.
Not a penny.
And if you get some, great, but it's 15 years out.
Yeah, I figure because, our parents are both alive.
However you believe.
It's going to them. I guess
one of the things that we like to do in retirement planning is all of our planning is focused on people having the greatest probability of being able to maintain their lifestyle without outliving their money. It's all based on probabilities. When I look at somebody who's been barely paid into Social Security because they paid into their pension, right? That's what's happened over those years. And so there's what's called the windfall elimination provision. That's one strike against you, like it or not. That's, I guess, the benefit. You got a pretty nice pension that nobody else can get at age 50. So that's one way to look at things. But then if we go out 15 years from now, when you're at your normal retirement age and the Social Security Trust Fund doesn't have enough money, there's a high probability that Congress is going to legislate it to say there's some people that don't need it, so therefore they're not going to get it. And you're in a good, that might happen to you.
I am 58 years of age. I suspect that I will be getting Social Security eligible. I expect exactly nothing from it. Not even a little.
Okay.
Right?
Gotcha.
And my planning, I'm older than you are. But look, and you could say it's fair or unfair. No one really cares about fair, right? It's if you have the means and the resources to support yourself without Social Security, our bet at Allworth.
We've heard that from both Republican as well as Democratic legislators. We've heard people. Chris Christie said if your income is more than $100,000 in retirement, you shouldn't be getting Social Security.
So to answer your question about the windfall elimination provision, there are programs that could help you predict what it will be, but that's not the question. Just if you get it, be happy. Wouldn't plan for it in my financial plan even a little.
It's a gift, basically.
Yeah, well, what are you going to pay into it? It's the taxation system in which we live in. If you get it, call it a gift.
It's a social welfare system, Social Security.
So anyway, appreciate the call.
Yeah, I wish we had more control over those things, but we don't. No, I don't want to be in charge of that. Can you imagine that? I remember years ago, just 15 years ago, they were talking about, maybe it was 20 years ago, having people opt out of Social Security and invest the money in the stock market. I mean, that's a great idea.
Yeah.
The average investor has really poor returns because they're not great investors.
Yeah, that would be great. Just taking people that have almost nothing and then telling
That'd just
them
be another transfer from the not wealthy to the wealthy.
Yes.
All right, we need to take a quick break when we come back. And we've got some more calls back on the backside here. But I also want to talk about health savings accounts and why they might be, why some say it's preferential to a 401k even. So that's some exciting radio for you. So you don't want to miss that. This is Allworth's Money Matters you're listening to.
Can't get enough of Allworth's Money Matters? Visit allworthfinancial.com/radio to listen to the Money Matters podcast.
Welcome back to Allworth's Money Matters. Scott Hansen.
Pat McLean. Thanks for staying with us. If you'd like to join the show, 833-99-WORTH. That's 833-999-6784.
Now, I don't know if I fully agree with this, but there was a study done by Wilson's Towers Watson. They specialize in employment benefits. That basically says young, healthy workers should favor health savings accounts after any 401k match. So if we look at health savings accounts are a type of accounts that are set up. They're designed to be for high deductible health insurance plans. If you have a high deductible health insurance plans, a way for you to save money in an account. So then when you have a health need arise that costs money, you can use your health savings account to pay for that out of pocket before the insurance kicks in. That's kind of the
versus a low deductible HMO type program. So what this does is actually you retain some of the risk in your health insurance versus an HMO or low deductible plan.
And so many employers have moved to this. Allworth, that's what we have for our employees.
As one of the options?
As one of the options. We also have an HMO option as well. You're correct. But for the high deductible HSA option, the maximum amount that an individual can contribute this year is $3,600. And for a family, it's $7,200 you can contribute. When you put the money in, you receive the tax deduction for the money that goes in. It grows tax deferred. And if the funds are used for health expenses, it's never taxed.
Comes out tax-free.
And you can leave it in there
50 years?
The rules will change in the future because right now it's...
This is what happens is unintended consequences. When the legislation was made, no one thought that they would be exploited in this manner, is to use it for saving dollars for retirement.
Now, unlike a 401k, which is you're stuck with whatever your employer's options are, with HSAs, once money goes in, let's say your employer chooses a credit union for the dollars to go into. Once it's in the credit union, you can transfer it to an independent custodian that enables you to buy low-cost index funds, for example, or even stocks.
And invest it any way you wish.
So it gives you a lot of investment flexibility. And when you look at what people, what medical costs are when you get older, it certainly makes some sense to look into if in fact you've got a high deductible plan through your employer, to maximize that HSA and to let the money accumulate over the years, not spend it, let it accumulate.
I proposed this. I've talked about this before on this very radio show. I proposed this to my wife, and we shut down.
When was the last time you proposed it?
Probably 2 years ago. I'm not stupid. I've been married for 35 years. You're only going to bring up the same subject ever so often.
Although I feel a little more stupid this last year because there's certain. I think with this whole response to the pandemic, my patience has not been what it typically is, and so usually things that I would be fine with my wife, sometimes I'm not quite as fine, and then we've gotten into arguments that I'm like, I know better. Like I should have let him gone there.
Well,
I should not have.
There may be some stresses on her as well. That is not only you that causes you both to react differently.
I hadn't thought about that.
All I know is my yard looks great because I just go around and walk around the yard.
All right, let's take some calls here. Again, to be part of the program, 833-99-WORTH. We're talking with Dave. Dave, you're with Allworth Money Matters.
Hi, Scott. Hey, Pat. So my question is first about annuities. I don't have an annuity. I have had several insurance companies trying to sell me annuities. I'm 63, probably a few years away from retirement. I probably have somewhere around $3.5 million in savings. Half of that's probably in, I'll call it my fund account, my joint brokerage account. The other half is in a self-directed IRA. I still work, so I have about $400,000 in my company IRA, or 401k, I should say, 401k.
So a 1.75 in qualified IRAs and another 400k in. And what's your approximate? Are you married?
Yes.
And what's your approximate family income?
225.
Okay. And do you owe anyone any money?
I owe nothing.
Okay. All right. What's your question for us? Oh, about the annuities.
So my question is, I want to talk about annuities, but I also like to talk about the Roth conversion. So annuities, what's your opinion on annuities? Are they good? Are they bad?
You need an annuity like you need another hole in your head. Seriously.
That's what I wanted to hear.
It's just garbage. For you, look, you have been obviously a great saver, assuming that none of this is inherited or gifted or a large settlement.
Even still, he has it. So,
but yeah, you're a good saver. We're looking at, $3.9 million in savings, right? 175 in brokerage, another 1.75 and 400 in a 401k. You're 63 years of age. You will easily be able to replace the family income, and you probably won't even need to replace 225. You're probably living on a lot less than that, is my guess.
The problem with annuities, you buy an annuity today, what happens? You give your money to the insurance company. They'll issue a block of annuities with an objective to raise a certain amount of capital, right? Let's call it $1 billion, whatever it is. Right. They'll come out with a new name for this product. They raise the amount of capital they need. Then they go in the marketplace and invest it primarily in bonds. So when that happens, you're buying bonds at very low rates.
And for longer maturities. If you're buying an index annuity, they take a portion of the returns from the bonds and they go buy options on an underlying index in order to give you some downside protection. But that comes at a cost. So there's no magic recipe that an insurance company has.
That they can do a better job investing than you can.
None whatsoever. It's how they're packaged and sold.
And they pay huge commissions to the agents. 5, 6, 8, 10% commission, sometimes more.
Wow, really?
Yeah, huge. It's unbelievable. I mean, we should actually start posting ads of these commission schedules on our website because I don't know if that's legal or not. Because the periodicals that we read have these ads. One of my favorite says your ship has come in. And this is selling to insurance agents, brokers.
That was maybe 20 years ago.
With their ship to come in and had the commission schedule there. Never talked about the product, just the commission schedule. So, but the point being is, I assume that your portfolio is fairly well diversified.
It is. It is. I'm in a lot of, on my self-directed IRA, I'm in a lot of index funds, large, small, balance between growth and value type instruments. So it's pretty well balanced. In my brokerage account, I'm not smarter than anybody else. I've just been extremely lucky, and it has grown tremendously.
Yeah, that's it.
Over the last 10 years, I've just been lucky.
Yeah, that's it. It's all luck.
Nothing to do with you saving and investing.
Nothing with you being patient.
You're like a victim. It just happened to you.
You're like the guy with a ham under his arm looking for a piece of bread. Look, you've been patient and persistent, and that quality, it will not change. And the idea behind annuities is how they're sold is to somehow give you downside protection or a magic panacea to market woes. It doesn't, the cost associated with getting there is not worth the money. That's just the reality.
And you miss out on so much of the market appreciation.
So
they're so restrictive.
So anyway, any other questions?
So I have one other quick question. So, so with all of the free money that we've been giving away lately with this stimulus and that stimulus, I am looking at, I understand that I have a large amount of money in a self-directed IRA, which is going to be brutal when I do turn 72, and the RMDs come into play, and that on top of I don't have any other pension plan or anything like that, but with Social Security, that's probably going to get taxed at pretty much 80%. So my question is this: if my income is $225, I'm anticipating the Biden administration is probably going to increase our taxes here in sometime in the next few years, if not sooner rather than later. So right now I have a sweet spot, the 24% tax bracket between the 170 and 325. So if I'm making 225, would it be prudent to pull out money out of my IRA? I'm 63, so I don't think I would be penalized. Correct me if I'm wrong.
Yeah, it wouldn't matter anyway.
But would it be prudent to pull that money out of my self-directed IRA, go ahead and pay the tax, roll that into a Roth, and keep my income under the 324 to keep me in that 24% tax bracket, as opposed to continuing to get potentially to see that 24 to go to 28 to go to 32, whatever. When I pull that money out,
we're with you. We understand exactly where you're going with this. So,
I mean, there's a high probability that your taxable income will be less in retirement than it is today.
That's what you have to play with.
Because because your brokerage account, for example, I mean, you could generate $225 a year now with your portfolio by having some IRA distribution, some capital gain realization from selling an appreciated security in your brokerage account, and then probably some cash from your brokerage account or something that hasn't had much appreciation. So you can structure your income with much less taxable income than you've got today,
and then do the Roth conversions then. So I know where you're going with this.
So you're saying that I would still be better off if I was going to? Because I'll tell you what I did. This year.
Go ahead.
Go ahead. Yes, I'm sorry. Go ahead.
Let's assume your retirement account's doubled in the next 10 years. Okay, so there's $3.5 million, and your requirement
of just 400 in the 401k, so it's 2.1, so it'd be $4 million.
Oh,
Well, I've heard two different numbers. So $4 million.
Okay.
Requirement.
So just figure this. So figure 1.5 is in a joint account outside of the self-directed IRA. In the self-directed IRA, there's let's just say
so it's $2 million bucks. Let's call it $2 million.
Yep, $2 million. That's a good number.
It's $4 million down the road. Your required minimum distributions at that point are 4% of that, or $160,000. It's just less than your taxable income today.
Right. Which would tell us that we shouldn't be doing conversions.
Well, if you do, you just need the bet you're making.
But what you would want to do is maybe wait between the ages of, let's say you quit working at age 67, you would actually want to do the conversions between the ages of 67 and 72. Right. Does that make sense?
That's kind of the sweet spot.
Yeah, once you're not working, that's
once you're working, because you could live off the brokerage while you're doing the conversions on the rest of it and convert at much more favorable rates than you would get a conversion at today. So the minute your income drops to zero, your earned income is when you actually just go all in with the strategy. And it may require you not taking Social Security for a number of years, which is a whole different question on the other side, which is a counterbalance to this. Which is the argument against this, which is maybe with this kind of income, you should start taking Social Security as soon as you can.
What state are you in again, Dave?
Kentucky.
What's the tax structure like in Kentucky?
It's like 6% state, and if I'm paying 24 right now, so I'm paying 30%.
If it were me, I would have a tough one to do.
I wouldn't do it. I wouldn't do it.
If it were me, I'd take the bet that I could still have some chances to manage my finances down the road.
In spite of the tax. How long do you think you'll be earning? The family will be earning $225.
In reality, I feel like if I lost my job today, I would be fine. In reality, I'm probably working for health insurance. So, I'll be 64 this year. So next, in 2022, I'll be 65. At that point, I do enjoy my job. So, the
Medicare kicks in?
I'll say, for argument's sake, a year and a half from now, I'm going to retire.
Then absolutely do not do the Roth conversion.
I would wait until that time when you retire.
Yeah. Yep. Absolutely. And then call our show and we'll walk through it again. But I wouldn't do anything until then.
Okay.
All right.
That's our opinion.
Very good.
All right. That's what he. I think that's what he called for. I think that's what he called.
Hey, wish you well, Dave. Thanks.
I appreciate. Thank you for the information and the guidance.
Yeah,
all right.
Appreciate it. Thanks. Let's continue with calls. Talking with John. John, you're with Allworth's Money Matters.
Hey, Pat and Scott. How are you?
We're well. How are you doing, John?
Good, thank you. So I guess let me just preface. I think what sparked my interest in connecting with you guys was something I heard from another caller a couple of weeks ago about alternative ways to, develop wealth, and didn't want to own his own home. He wanted to possibly invest in real estate, and so I think I found myself currently in a situation. I've been renting for some time for a number of reasons. I mean, wanted some flexibility for a period of time, post a divorce, and then previous to the pandemic, really thought there might be a drop in values. But I've also owned a duplex for some time.
You still own the duplex?
I do.
Okay.
And I've pondered, what to do with it for some time. It's managed by a property management company, and a check comes in the mail every month, right, so to speak. I mean, it's been fairly maintenance free. Lived there a long time ago, but long since have not lived there. And so, anyways, I expect to probably buy my own residence. I think I'm going to get into the housing market, and I want to own something again for myself. I think that's the right thing to do. I've had subpar rent for some time, and then about a year ago that went up, and the pandemic happened, and I just thought that I'll wait it out. I have cash in the bank, and with interest rates where they are, and I don't necessarily see things backing up.
Yeah. So, so your question for us is,
what would you do with the duplex?
Oh, I'd keep it.
Try to.
What's your?
What about a 1031 exchange?
My first thought you could do a 1031 exchange into a new property, sell the duplex, transfer it into a home, but you can't immediately go live in that. You'd have to rent it out for a period of time,
for a number of years, and if you could,
maybe not a number of years, but some period of time.
But if you've got a foothold in real estate, so you can do that at any point in time.
Right. And in fact, that recommendation's been made. I mean, I've looked at
what's the duplex worth? Both of them. What are they worth? Come on.
650, I'd say. Maybe more. But
what do you owe on it?
It's been paid off for a while.
And what's your annual income?
Yeah, thank you.
My annual income without rental income, put it at 130, and then another 34 on the duplex.
How old are you?
56.
And what do you have in 401ks and IRAs?
1.4 in IRA, 70 in Roth, and a little bit in a 401k because I moved jobs recently.
Do you owe anyone in the world money?
No.
How old are you? 56. Do whatever you want.
I almost said the same exact words.
Do whatever you want. You're golden. Look, you can afford to go buy another house and keep the duplex, which is why I started with.
Okay. All right. So let me ask you this. does it make any sense to go invest in a primary residence and another, property, small single-family home?
Well, it depends on what you want. The best thing you could do is
what do you have as far as cash sitting around?
250.
Yeah, you could do
maybe a little bit.
I would tackle one at a time. I'd go get yourself a primary residence that you want to live in. Make it your forever home. Put as much cash down as you possibly can. Get a 10-year fixed rate on the remaining amount, and try to pay it off by the time you're 66. And then keep doing everything else you're doing. That's what I would do, because at some point in time, you're going to have to land somewhere. Now, where do you live now? In what part of the country?
Oh, I'm Sacramento.
Okay. Do you plan on staying in Northern California the rest of your life?
I don't know. I mean, I hear you. You know, I've been a long time listener to the show, and I when you ask people that, my answer, I always say to myself, I don't know.
All right. Well, then that means you're probably going to stay here. So that's the when you say I don't know, you haven't given it any thought. You haven't. Like I have friends that went down to.
Well, you dream.
Yeah, well, no, I have friends that went to Florida last week to see what it looked like on the Gulf Coast and to Destin, Florida. And they've gone past the dream stage. They're out looking. So in your situation, go buy a home that you feel comfortable that you can live in for the rest of your life and put as much cash in there and finance the rest over a 10-year, 15-year note. Try to pay it off before you retire and keep the duplex. Scott?
Yep. I wouldn't buy another
duplex. No, you don't need to. Yeah. You're doing fine without it. Just get a house.
You wouldn't trouble yourself with another.
I personally have two residential rentals, and about once a month I ponder selling them. So
you manage them yourself?
No. Oh gosh, no. Else? No, but even I'll get an email like, I have a really good property manager where he takes care of stuff, but it's just.
But the point is you're going to need some place that you're going to want to land and live forever, and it's not going to be a rental house. So that's why you're going to go buy the house that you plan on living forever. It doesn't have to be super elaborate. It doesn't have to be an over-the-top neighborhood. You should think about when you're 75, probably want a single floor story. Well,
he may or may not want to live in the same house for 15 years.
Well, but you're going to plan like that. Don't you plan like that?
Yeah, just remodel. I've been in the same house 17 years. We just remodeled it. Yeah. My wife says we're not going anywhere. They'll probably have to probably remodel again in 15 years, I guess.
We repaint the inside of our house every 4 years. My house is 200 square feet smaller than it was when we moved in.
Just the paint.
Just the paint. Anyway, appreciate the call.
Thank you.
Thanks, John. Let's now talk with David. David, you're with Scott Hansen, Pat McClain, Allworth's Money Matters.
Hello. Thanks for taking my call.
Yeah.
I've been reading about this great reset, and it's got me kind of worried about my future retirement. And I was just wondering what you thought about that, and maybe also what you thought about cryptocurrencies, specifically Bitcoin and maybe precious metals. Is it part of your investment portfolio?
Yeah, what reset are you talking about?
Well, it's this great reset where supposedly, there's going to be a socialist transfer of wealth, and I guess because of the unfunded liabilities and the trillions of dollars of debt and the money printing and.
I remember when I was I graduated in high school in 1984, and around 1980, I'm trying to remember when I had. It was sometime a couple of years after that, and I had a friend of mine who was a few years older than me. We met for breakfast, and he gave me a book. The Coming Economic Doom was the title. This was mid-'80s. The Coming Economic Doom. And it made this argument based upon the deficit spending at the time and the debt and why stocks were going to plummet, blah, 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 blah. And I remember that because I think if I would have followed that advice in the 80s, how different my life would be today. Because we've had anything but an economic doom. I mean, it's been phenomenal times for many Americans over the last 3 decades, 4 decades. So we have some issues in our country. If there ever some sort of time when the U.S. dollar is of little value, we're going to have absolute chaos here. And I think what you want is political connection more than anything else at that time, depending on what kind of great reset you're talking about.
Yeah. So
I personally own no cryptocurrency. I personally own no precious metals. So it's hard for me to advise
on a great reset that I don't believe is going to happen.
Yeah.
Will there be a transfer of wealth? Oh, you bet. There's always been a transfer of wealth. Sometimes it goes from those that don't have so much to those that have a lot, and sometimes it goes the other way, right? That is just how it works. Are we going to become a communistic society? No. Are we going to become a little bit more socialist? Yes. Will we get through it? Yeah, we'll get through it.
Have we been more socialist in other periods of time?
We
Yes.
have absolutely been more socialist in other periods of time. The pendulum will swing. It normally swings too far in one direction for a period of time, and then it swings back again. Look, you can prepare the portfolio for anything scenario you can create in your mind, and then you could make an argument as to why it should be that way. I can just tell you, our experience is, will cryptocurrencies play a role in the future? Possibly.
The technology certainly will.
Yes, blockchain is here to stay. And by the way, it's been around for a long, long time. Precious metals, I have no interest in them. So anyway, appreciate the call.
Yeah, and let's all hope there's no big great reset. Well, unfortunately, this is all the time we have this week. But as usual, it is great to be with you on the program here. And if you don't listen to us via podcast yet, you can go to our website. It tells you how to subscribe, or wherever you're getting your podcast. You can just sign up for the podcast there. And if you haven't been on our website in a while, we've got a lot of great tools on our website, calculators. It's just like this program is very educational. You'll find our website is very similar, very educational, allworthfinancial.com, and you can spend all the time you like there.
You can spend days there if you wish.
You could, yeah. Anyway, it's been great being with you. We'll see you next week. This has been Scott Hansen, Pat McLean, Allworth's Money Matters.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.